Hey, I hope you're all doing well out there. This is your June market review. So for those of you that are newer to watching these, the reason that I put this video together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this is to just give you the information about what's going on in the stock market and the economy, and then how that affects your money as an investor. So stocks for the month of June were down about 8% for the month. That ended the second quarter, which was a brutal second quarter, where the S&P 500 was down about 16% for the quarter, after being down about 4% for the first quarter. So for the year, stocks are down about 21% at this point. So there was a small comeback that stocks had towards the end of May that bled over into the beginning part of June. And then the last few weeks here of the month, the stocks really had fallen off pretty dramatically. So what I want to talk about more this month, and the charts that I have to use to talk more about. So for those of you that are newer to watching this, I use a lot of charts because talking about investments, investing in, especially in stocks, is very intangible thing. So I try to use charts so that way it's a better visual for you all to see exactly what I'm talking about and better understand, what's going on in the stock market and the economy, so that way you can get a better feel for your investments as a whole. So, but what I want to focus on here is kind of that big picture aspect of where stocks are at, where they've come to, and likely, where they will head. So the first chart that I have shows the performance of the first half of the S&P 500 going back to 1970. So the worst time frame for stocks since 1970 was this year. So if we go back even through 2008, not that bad. We go back all the way into the mid 70s. There was a couple years where we were in recessions in 1973, 74, and you can see those down markets at that point. Markets were down 10%. So stocks have really already baked in a large drop, and we're not in a recession at this point, at least that we know about. So not to say that we aren't in a recession, which will lead me into my next chart here. So the reason I brought this first chart up was I just wanted to give you kind of a better picture of where we're currently at, and compare it to previous years. So if we look at recessions, the next chart here goes to recessions going all the way back to the end of World War II, and every recession that we've had since then. And the bar graph is showing the drop from the peak prior to that recession to the very bottom of that recession. So the worst time frame since World War II was 2007 recession that led all the way through March of 2009. So that recession, markets dropped about 58%, as you can see there on the chart, followed by the second worst, which was the dot-com bubble that then preceded actually the 2001 9/11 recession. And really stocks kept actually dropping even after that recession ended through 2002. So that's one of the reasons you see that down about 50%. There's 1973, 70, 2020, so on and so forth. So the median, and what I thought was really interesting, this is actually my favorite chart I came across this past month. The reason I wanted to talk more about this is because the median drop for the stock market over all of these recessions was 24%. So stocks right now are down about 20%. There's a lot of concern that I've heard either through investors or just people that I hear in my travels that are concerned about how much further stocks are going to go down. And statistically speaking, as you can see in this chart, we're right at a median. Not to say it's not going to go further than that, because it's just the median. So that's like that middle ground territory, using these 12 different recessions that have been, that we've had since World War II. So I thought it was an interesting piece because we are really down a lot already. And whether we're in a recession or we're not in a recession, you don't know if you're in a recession until months after, because a recession is always a backwards looking number. It's based on GDP, which is gross domestic product. So that's how much as a country we produce, imports versus exports, and really the growth of the overall economy. So those are big things that lead into whether we're in a recession or we're not in a recession. If we have 2 quarters of negative GDP, then we're technically in a recession. But you don't ever know that until well after that quarter is over. So that's the reason I say that. So whether we're in a recession or not in a recession, then where we're at right now within the overall markets, we've already dropped off a lot. So I fielded some questions from people, should we move more money to cash right now? And my answer to that, and to all of you that are watching this, is no, because we don't know where the market is going from here. So it's already dropped 20%, that we know, that's a given. But we don't know when it's going to turn around, because the bigger things that are happening right now, with war going on in Ukraine, we have inflation, which they're raising interest rates to help try to combat that. And then you have China lockdowns, which are really, messing up the second largest economy in the overall in the world, and slowing down supply chains, which affect everybody else. So if some of those things start to turn a corner, if there's some sort of peace talks that end to the end of a war in Ukraine, if China does open their country back up and supply chains start getting fixed, if inflation does start coming down, we're going to see stocks turn a corner, and they're going to do it on a dime. They're not going to announce that all of a sudden they're going to go higher. That's not the way that investing in stocks works. They don't tell us they're going to go down. They don't tell us they're going to go up. It's just investors that are buying or selling based on where they feel the market is going. And we then, as financial advisors or investment managers, are looking at things of bigger picture of, well, if markets are down 20% historically, is this a great time to buy? Historically, the answer would be yes. So is it a great time to sell? The answer to that would be no, because if things do turn a corner, then you've locked in losses if you've already sold those positions and put them in cash. And no, we can't just all of a sudden see that it's turned a corner and then just reinvest that money. And fortunately, if it were that easy, I wouldn't be creating this video or managing your money. So I'd be a whole lot wealthier and dealing with probably something a little bit different than shooting a video, doing a monthly market review right now. So that's just not the way that investing works. The smartest investors in the world can't predict that type of thing. So I'm not going to try to take a stab at it either. So I thought that was an interesting chart and talked a lot about where things are at from a drop in markets. So we're not in a recession, which is why 2022 doesn't show up on there. But we've already come down pretty dramatically in the last 6 months at this point. So next chart I had goes into one of the reasons why, whether we're in a recession or not in a recession, why this would not be a good time to decide to sell stocks. And this is a chart showing the US households cash or cash equivalents. So in 2015, as a country, we were at about $10 trillion in cash or cash equivalent. This number has gone up 75% cumulatively over that time frame from 2015 through today. And this is just a great sign showing that people have more money in cash just sitting around. So stocks dropping the way that they have, there hasn't been this huge surge of cash going into the market at any point. So people aren't piling out of the market, which if you saw the market review from last month, I had a chart that showed it was either last month or the month before, but it showed a chart with where individual investors had their money invested in stocks, bonds, and cash. And there wasn't this huge spike in cash, which typically happens when there's a big market drop-off. So individual investors especially are at least staying invested. As a whole, the US households have a ton of cash that's on hand. And this number, obviously, since 2020 went up dramatically, and that was because of all the government stimulus and really the effects of COVID, because people stopped spending money. So the US consumer still has a lot of money, which again, we're predominantly, as an economy, 2/3 of our GDP go back to US consumer spending. So if the US consumer is doing well and they're feeling good and they have cash around to spend on things that they need, they're going to feel okay. Now, inflation is really eating into that, which is probably I know for the Federal Reserve, that's their biggest concern. For me, that will probably be my biggest concern of where markets go, is what happens with inflation. So if inflation continues rising, that's going to be a really negative thing for stocks. If it can get under control, though, and the Federal Reserve brings that number down, we're going to see stocks start to rally. So we don't know when that's going to happen. Over the next week, they're going to release the next CPI number, which is Consumer Price Index. That's the number that tracks inflation. So of the fluctuation of inflation up or down. So if that number starts ticking down a little bit from where it's at right now at 8.6%, if it drops below where analysts are estimating it to be at, that would be a good sign of it turning a corner. So thought that was a good chart to pull up and just talk a little bit more about. Last chart I have for you is a chart that shows, speaking on inflation, a chart that shows gas prices adjusted for inflation versus their nominal value going back through the late 1970s. And in the teal color you see there, that is the price of gas based on May 2022 dollars. So that's accounting for that inflation versus the unadjusted price in that red color on the bottom part there. So the unadjusted price would have been in 1977, whenever that was. At that chart, at the end of that chart, you're paying about 75 cents. So when people are looking at gas prices going up to $5 and they're comparing it back to when it was 75 cents, it's not taking into account inflation, because everything has gone up since 1977. It's not just gas. So, eggs, food, housing prices, stocks, everything has gone up in value because of inflation in that way. So what I thought was interesting was to look at that spike that we had way back in the early 1980s. That was the very peak of inflation actually at the time. And at that point in time was roughly about $4.50 if we're looking at it in today's dollars. Then there was a huge drop off because not only did inflation come down, gas prices, the unadjusted price came down as well. But if we fast forward all the way through today, actually in 2008, when we went into the recession in right after 2007, gas prices at that point, based on inflation, were actually higher than they are today. But we're at a peak, but so is the unadjusted price obviously has equaled that, inflation adjusted price, because they're the same spot right now. But I thought it was interesting to see way back kind of tracking where the fluctuation of that's gone. So obviously we're at a higher price overall. This is something that everybody feels if they drive a car. It's definitely probably one of the most common things that is affecting just overall consumer spending out there, because people are having to spend more money on gas. One of the reasons that you see airline tickets going up is because airlines are now having to pay higher prices for gas. So, but it's interesting to see those types of charts, and I thought that would be something relevant for all of you out there, kind of looking back on that and comparing it. So, and thinking back for those people that were driving in the late 70s, early 80s, on where those prices really were if we accounted for inflation at that point. So those are the charts I have for you this week. If any of you have any questions for me or need any help, anything like that, don't hesitate to call, text, email. I'm always available. If you'd like to chat on where things are at and your account specifically with me, feel free to reach out to me. I'd be more than happy to specifically go over what we're doing with inside of your account, changes that have been made here over the last month, because there's been rebalances that have happened here over the last month. So if you have questions about that, definitely reach out to me. We can talk either over the phone or do a Zoom meeting. I'm more than happy to catch up that way. If you have friends, family members, coworkers, someone you feel would be interested in having a conversation with me about where their investments are at or getting money invested at this point, I'd be more than happy to have a conversation with them. If you also have money that's sitting in cash and you'd like to have a conversation about where to have that money invested, whether we're talking more conservatively or more aggressively, be more than happy to have that conversation with you as well. But feel free to reach out, whichever way is best for you. But I appreciate you all taking the time to check me out. Until next time.